we did have new highs on the year for both gold and silver. Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today on the show, we're going to talk about how gold and silver are now at new highs for 2023 following some data that came out earlier this morning on Thursday, including the producer price index, which came in lower than expected, fell in March, as you can see here, and actually dropped 0.5% last month and was down 2.7% year over year. Big part of that is that you had the drop in the gasoline prices, and also that the March of 2022 number, which was a bigger one, has dropped out of the index, something that Craig Hemke of TF Metals has pointed out a couple months ago and made a lot of sense, where some of those big figures from the last year will continue to drop out and leave some of these figures we see going forward a little lower just due to that alone. But in either case, we did see a 0.5% drop over the last month, which has contributed to today's rally in the metals, which we'll get to in a second. Quick look at the dollar index on the news, down 54 cents to 100.96. And as you can see here on the one-year chart, quite a drop, where back in September of 2022, we were up at 114, now down below 101. So not surprising that we've seen a sizable move in gold and silver based on the trend that we are seeing here, especially as the Fed gets closer and closer to the end of its interest rate hikes, with the market largely pricing in a 0.25% hike at the May meeting, which they are expecting to be the last one. One other note here on the producer price index. This is the biggest month-over-month drop since April of 2020, lowest year-over-year print since January of 2021. Although, again, with a rebound in the energy prices, a decent chance that we will see a higher number next month going forward. But this is one of the things that the market is reacting to today, along with the Fed minutes from the last meeting that came out that showed that the Fed expects a banking crisis to cause a recession this year. Obviously, a lot of people that are into the metals, probably yourself included, we're already thinking that, but now we see that the Fed is discussing that possibility as well. Here we have a note from the meeting summary that, given their assessment of the potential economic effects of the recent banking sector developments, the staff's projection at the time of the March meeting included a mild recession starting later this year with a recovery over the subsequent 2 years. So now we see the concerns of recession even being factored in by the Federal Reserve. So certainly something to keep an eye on. And as we take a look at the futures pricing for the next meeting, about 65.35 in favor of a 0.25 point hike. That's going to be coming on May 3rd, so just a few weeks away. And again, if we take a look at the probabilities here, we see that 0.25 point hike priced in, followed by a series of cuts, with the first one being priced in July, then another in September and December. And certainly if the banking issues do escalate, that would go a long way towards seeing this sort of curve. So as I mentioned, we did have new highs on the year for both gold and silver. Silver earlier this morning actually broke over $26 in the futures contracts, just slightly below that at $25.90 right now. Taking a look at gold, we see gold got up to about $2,060, just about $17 off of the 2022 highs shortly after the war in Ukraine broke out. Price has come back in now, although trading at 2055 early on Thursday morning. So on one hand, certainly good news for gold and silver investors. On the other hand, not entirely good news given some of the things that we see going on in the world and the way things are getting dicier with the economy as we go day by day. But at least today, seeing the gold and silver prices up a bit. And in terms of where we're going from here, a few notes to pass along. This is from Nikki Shields, who is a metals analyst. Mentions, anecdotally, I'm getting increasingly more questions from my inner circle who are not in finance about whether they should and how much to allocate to gold. That group was surprisingly quiet on gold last year, even once war and inflation merged. Now SVB has fundamentally changed how people perceive the safety of their wealth at a time when the economic outlook is worsening. New gold players equals a new pricing regime. And certainly that's what we've been hearing from the bullion dealers. Andy Scheckman, who comes on every Tuesday, had a large inflow of new customers who are saying essentially the same thing, and seems as if the events that for a long time were largely ignored are spreading a bit more to the mainstream. Here's a note that came out on Bloomberg a couple of days ago. This is from Jörg Kiener of Swiss Asia Capital, who was talking about silver. So let's play a little bit of what he had to say here.
Monetary function in that respect, but when you're talking about gold, so how does this extrapolate out, because not everyone wants to invest for those same reasons into gold. Is silver going to catch those tailwinds? Are the other precious metals in the basket going to catch those tailwinds? Or is it specifically in your view that it's gold where you should be positioning?
From a central bank point of view, it's going to be gold because it's the only thing which is big enough to actually change the structure of a big asset allocator. A larger fund could actually clear tomorrow morning the silver pool, right? And if you look at the LME, basically, the LME has what for most metals, 2 days delivery. Who wants to deal with somebody who's got 2 days delivery function? So you're actually going to see that the market becomes much more physical, and that means actually all commodities actually look good, particularly silver, which actually is trading historically on such a beaten down level in an environment where it's been in backwardation for as long as I can see. I think it's going to be ready for a massive move as it starts finding interest.
So I pass that along in the sense just that we've talked a lot on the show of when does silver begin to catch up to the gold price, with a lot of people, including myself, believing that once you start getting more mainstream fund participation, and here is one fund manager talking about that, and certainly with both metals hitting a high on the year, that would seemingly be a big step towards getting some more mainstream participation. Again, a note that came out a couple of weeks ago. This was from John Paulson talking about you need to own gold, not dollars, for many of the same reasons that we've talked about on the show with the de-dollarization and other factors in play that are driving people into the metals. And an interesting note here from Goldman Sachs. This came out back on March 7th, but did want to pass this along. Given the material upward revision in investment and central bank demand assumptions, we now upgrade our 3, 6, and 12-month gold targets from 1950, 2050, and 2150 to 2300, 2500, and 2500. So significant increase there, and gold at that 2060 level, not all that far off from 2300, which certainly seems reasonable in the next 6 months, especially if we do get a continuation of the banking issues, which would certainly be somewhat fueled by another interest rate increase in a couple of weeks. Meanwhile, as that's happening, one of the things that is leading to those banking issues is that money supply has been falling here at the fastest rate since the 1930s. And they mention here in seasonally adjusted terms, M2 money supply fell 2.4% from the same month last year. And we can take a look at the M2 money supply. This is the 10-year chart. Actually, let's go back to the max chart just so you can get this in context, because you see rising steadily, then really accelerated following the great financial crisis, then took another leap forward here following the COVID events, spiked quite a bit to over 21 trillion, now has been coming back in over the past year, which we can see here a little more clearly on the 5-year chart. And of course, that's the biggest concern when you have quantitative easing, 0% interest rates, floods a lot of money into the system, which pushed asset prices higher. Although, of course, when that money is taken out, you get the kind of issues that we're experiencing now, which is what we've been talking about on the show for the last year, and why so many people feel the Fed will eventually be forced to reverse course and pivot and begin lowering interest rates, which, again, the futures market is pricing in will happen this year. Of course, another thing to keep an eye on is that we have the U.S. debt ceiling standoff, which could happen as soon as July. And my guess is that eventually they do raise it, although certainly something just to keep an eye on, given how divisive. I suppose American politics have always been a bit divisive, yet seems like we may be seeing even a higher than ever level of divisiveness between the two parties and the politics that are going on. So while it may be raised, keep in mind, if you go back to 2011 when gold hit its high back then of over $1,900 an ounce, that was following the debt ceiling debate, which did get raised, yet really put a lot of attention on the finances and the precarious position that the U.S. debt load and government structure is in. So something to keep an eye on as we move forward. Also, a story from Forbes, again, shedding more attention on the gold market. And here, even talking about the gold standard, as they mentioned, bringing up the subject of the gold standard is strictly verboten in the economics profession and among financial policymakers. It's a long past time to break this taboo. And the article talks about some of the history of the gold standard, mentions inflation never occurs with the gold standard. Obviously, if there was a cap on the amount of money that was able to be printed or borrowed, that would change things quite a bit. And obviously is a big reason why price of things have accelerated so much, not only in the past couple of years, but the past couple of decades. So if you want to take a look at this one, you can look for Forbes Gold, the Forbidden Cure. And I just find it interesting to see how stories like this are coming up once gold has crossed over that $2,000 level, and would expect that we will see more of that going forward. Before we wrap up, a quick look at the silver inventories, which we've tracked quite a bit on the show here. Again, you had the 150 million ounces in the COMEX registered stockpile, which dropped to the mid-30s late last year, has somewhat flatlined over the past couple of months, similar to how the LBMA data shows that you had this big drop off here and then has also flatlined over the last couple of months. Heard some people suggest that we're basically at the point where it's hard for them to deliver more. Whether that is the case, we will see, although just interesting to see you had that big drop off, and both of these have basically stayed flat over the past couple of months. So we will keep an eye on that going forward. And in wrapping up, did just want to mention that yesterday Fortuna Silver released their production results for the first quarter of 2023. Actually did have Jorge Ganoza, the CEO of Fortuna Silver, on the show yesterday, along with Dave Kranzler, and he gave an update on those results, as well as how things are going at the Seguela Gold Project, which is nearing first pour in May of 2023, so just a month away. And hear more about what he had to say about that, well, that video is coming your way now.